What if I told you, one investment decision you make today could quietly outperform thousands of individual stock picks over the next decade? No chasing the next Nvidia. No guessing which AI company will win. No checking your portfolio every hour. Just owning the right ETFs. And letting America's biggest companies do the work for you. But here's the catch. Not every ETF is built to survive the next 10 years. Some may barely beat inflation, while a handful could become the foundation of serious long-term wealth. So if you were starting today, which ETFs deserve a place in your portfolio? Let's find out. Why ETFs are winning. Over the last decade, millions of Americans have stopped trying to beat the market. Instead, they're buying the market. Why? Because history keeps repeating the same lesson. Most professional fund managers fail to outperform broad market indexes over long periods. If experts with billion-dollar research teams struggle to beat the market, what are the chances that the average investor consistently can? That's why ETFs have become one of the fastest-growing investment choices in America. They're simple, low-cost, diversified, and designed for long-term investing. Instead of buying one company, you instantly own hundreds, or even thousands, of companies with a single purchase. That means if one company struggles, the others continue working for you. And that's exactly why long-term ETF investing has become a favorite strategy for retirement accounts, first-time investors, and even experienced millionaires. But here's what most beginners get wrong. Many people search best ETF, as if there's only one answer. There isn't. Every ETF has a different job. Some focus on the biggest US companies. Some own the entire stock market. Some focus on technology. Others generate dividend income. Choosing the wrong ETF isn't necessarily dangerous. But choosing one that doesn't match your goals can cost you years of potential growth. So instead of asking, what's the best ETF? Ask, what's the best ETF for the next 10 years? That's a completely different question. Because now we're looking for funds that can benefit from long-term economic growth, not short-term hype. ETF number 1. VOO. Let's begin with one of the most popular ETFs in America. VOO. VOO tracks the S&P 500, meaning you own approximately 500 of the largest publicly traded US companies. Think about names like Apple, Microsoft, Amazon, Meta, Berkshire Hathaway, and many more, instead of betting on one winner. You're investing in America's strongest businesses all at once. Historically, the S&P 500 has delivered attractive long-term returns over decades, although future returns are never guaranteed. That's why many financial experts consider VOO a core investment. Especially for beginners. It's simple, low-cost, highly diversified, and designed for investors who don't want to constantly buy and sell stocks. If someone asked, I only want one ETF for the next 10 years, VOO would almost always be part of that conversation. ETF number 2. VTI. Now here's where things become even more interesting. Many investors think, if 500 companies are good, wouldn't owning nearly the entire US stock market be even better? That's exactly what VTI offers, instead of owning only large companies. VTI includes large cap, mid cap, and small cap businesses. That's thousands of American companies in one ETF. Why does this matter? Because tomorrow's biggest winners may still be small companies today. With VTI, you already own them before they become household names. It's one of the easiest ways to invest in the entire US economy. As America grows, your portfolio grows with it. That's why many long-term investors love combining simplicity with maximum diversification. Quick comparison. VOO versus VTI. So, which one is better? Honestly, neither. They're simply different. VOO focuses on America's biggest companies. VTI owns almost everything. The performance between them has often been very similar over long periods. The decision usually comes down to personal preference. Do you want the biggest corporations? Or the entire US market? Either way, you're building a portfolio around long-term economic growth instead of speculation. But what if you want faster growth? Everything we've discussed so far is built around stability. But what if you're comfortable with more volatility in exchange for potentially higher long-term growth? That's where our next ETF enters the picture. And it's probably one of the most talked about ETFs in the world. We'll cover that next.